All right. Welcome, everyone. Thank you very much for joining me today. My name is Ilian Yotov, and we're going to spend some time today to take a look at what may be coming up for the first quarter of 2011. Yes, it's that time again. It is time to look ahead at the new quarter, and we're starting a brand new year as well. So what we're going to do in the program today is take a look at what may be coming up for the major currencies for the new quarter. A little introduction for you, those of you who are not familiar with my name. I'm the creator of the so-called Quarters Theory, FX strategist and author of the book, The Quarters Theory, the Revolutionary New Foreign Currencies Trading Method. I'm the founder of allthingsforex.com and tradertape.com and the host of the popular All Things Forex broadcast. It's a daily program that gives traders analysis of the major economic events and the latest developments with the currency majors Monday through Friday, 1 to 2 p.m. Eastern Time. I think that looking into the new quarter, as we do every time I have these programs, and first of all, thank you to FX Street for putting the event together. What we do is normally we ask, will the previous quarter trends actually continue in the new quarter? In this case, we have a new quarter and a new year that's starting. So the main question that we need to ask now is, will the current quarter number 4 of 2010 trends continue into 2011? And what we can expect? Will the US dollar continue to get punished in 2011 for the Fed's ultra-accommodative monetary policy? And also for the lack of fiscal austerity in the United States. I mean, of course, we have some potential there for some changes as far as U.S. government spending reductions and so forth that are being discussed recently, but nothing really written in stone at this point. Other question is, should we expect more risk aversion and further safe haven currency strength in the first quarter of 2011? Safe haven currencies such as, for example, the Swiss franc are doing very well in a current environment. Japanese yen continues to be strong against the US dollar. What could provide the clues for things to come? Well, some of these questions and factors to watch we discussed in our previous webinar, looking at the fourth quarter of 2010 and the third quarter of 2010. And some of the 7 factors that we listed at that point continue to be very important for us to watch going forward. The sovereign debt crisis, especially the one in the Eurozone, worldwide economic slowdown expectations, fiscal austerity measures that may be taking their tolls on some of the major economies around the world. Interest rates, of course, always important for the major currencies. In the third quarter and fourth quarter, we watched the market's reaction to the European Union bank stress test, if you recall, the U.S. and the G7 corporate earnings, FX reserve diversification trends, and so forth. Some of the major factors that we'll continue to watch forward as well. The 10 factors that we said we're going to watch in the fourth quarter of 2010 were sovereign debt crisis, worldwide economic slowdown, especially China cooling things off a little bit with surprising interest rate hike that we witnessed in the fourth quarter of 2010. Some of the requirements also were raised for funding requirements for the banks and reserve requirements in an effort for China to step on a brake pedal, if you will, to cool things off with their economy and prevent some asset bubbles from developing. Fiscal austerity measures that were being implemented all across the Eurozone that could harm the economic recoveries in these nations, and also massive fiscal austerity, the largest fiscal austerity measures that the United Kingdom's government is undertaking, the largest since World War II. Monetary policies of major central banks, there are some stark differences, obviously, between the monetary policies of, for example, the Federal Reserve and the Bank of England, the Bank of Japan. Both of these central banks are what I call ultra-accommodated. They're keeping interest rates at record low levels, near 0%, and on top of that, offering more stimulus, quantitative easing measures to stimulate the economy. As opposed to, for example, other central banks like the Reserve Bank of Australia, who have been raising interest rates in 2010 and are definitely not as accommodative as the Fed here in the United States might be perceived. That creates, of course, interest rates and yield differentials, which continue to be major factors, and we know that for the most part, the Australian dollar continues to remain well bid, even to this minute, against the US dollar on these interest rates and yield differentials. The US dollar carry trade saw a resurgence in the third and the fourth quarter, especially, of 2010. That was a factor that we said we're going to watch in the fourth quarter, as we were preparing 3 months ahead to this day. The U.S. and the G7 corporate earnings, foreign exchange reserve diversification, which has been one of the major trends in a previous decade, as foreign exchange reserve managers were looking for alternatives to the U.S. dollar, diversifying into other currencies. And the euro was a pretty decent alternative at that point. But it seems like with the Eurozone debt crisis and financial crisis, things have changed as far as how the euro is perceived as a store of value. And also another factor we watched was the U.S. midterm election in November. It seems like we had a little bit of a change that happened. Many of you have probably noticed. The Republicans here in the United States actually took the majority of the House and reduced the Democrat majority in the Senate. This is a factor that we'll continue to watch as the new House and Senate begin their sessions in the new year. We'll see whether there will be some new laws and possible some more fiscal austerity measures that might be considered and announced in 2011 by the U.S. government. What we noted is in a previous couple of quarters was that the euro-US dollar currency pair had a bullish short-term trend reversal, a bearish trend. The euro was very weak in the first half of 2010, as many of you would recall. But we saw that coming to an end, and the euro started to strengthen here in the third quarter, and the strengthening of the euro continued into the fourth quarter of 2010. Although, in the recent couple of months, by the end of the fourth quarter, we actually saw more concerns of the Eurozone debt crisis taking their toll on the euro. The pound pretty much did the same. Negative trend for the first half of 2010 was reversed in the second half, although the British pound is coming under pressure again in the last month or so of trading towards the end of the quarter. The dollar continued to stay weak against the Japanese yen, producing new all-time, or actually 15-year lows for the dollar against the Japanese yen, close to the 80 yen level. What was a stronger US dollar trend in the first half of 2010, in the second half, was completely reversed. The dollar came under pressure. The dollar against the Swiss franc was doing well in the beginning of the 2010 until June, and then we also saw the US dollar reversal, and the Swiss franc continues to be well bid against the US dollar. Same thing happened with the Australian dollar against the US dollar. There was a reversal in the Australian dollar negative trend in the first half of 2010 on the debt crisis concerns and risk aversion. The Australian dollar found a bottom above the 80 cents level in last summer, and then to this day continues to remain strong versus the US dollar. The bearish US dollar trend versus the euro and the pound, however, came to a halt by the end of the fourth quarter. Will the US dollar continue to gain strength in the first quarter of 2011? I should change this. Sorry about the typo. Well, if you recall, in my previous Outlook webinar, I raised the question as to whether or not the euro was actually forming a bubble. There was a 19-day non-stop rally at the time of our last quarterly Outlook webinar that I started asking, is the 19-day rally of the euro versus the US dollar a warning sign of a bubble? Or was it simply the market decided to continue the, quote, business as usual for the currency majors, leading to a renewal of the multi-year bearish trend for the dollar from the last decade? Because the US dollar has not weakened since yesterday. It's been a multi-year negative trend for the US dollar that may have come to a halt in some months of 2010, but for the most, in 2009 and 2008, in the last couple of years, But for the most part, and we'll take a look later on at the longer term trend of the euro-dollar pair, you'll see for the most part the euro is still in a multi-year positive trend versus the US dollar. So in my previous webinar, I laid down some of the characteristics of a bubble. At that time, by the way, the euro was approaching the dollar and was well into the $1.30s, and it was approaching the $1.40 area. It has managed to basically bounce off of some recently established low. I believe it was a 4-year rather low for the euro against the US dollar that the euro was bouncing off of, which was a little bit below $1.19. So we said that according to sources like the Wall Street Journal article, Bernanke's Bubble Laboratory, which was a Princeton student study on the economics of manias and bubbles, we said that there were some significant characteristics, several different characteristics that would let us know that we may be having a bubble. First one was the bubbles emerge at times when investors profoundly disagree about the significance of a big economic development, such as, for example, electricity and autos in the 1920s, the internet in the 1990s, the growth of China and India, because it is so much harder to bet on prices going down than up, the bullish investors dominate. At the outset, a surge in the values of related businesses and goods is often justified, and then it detaches investors from reality. So with the euro rallying as much as it did from around $1.19 to about almost $1.43, and especially ahead of the Fed's interest rate announcement on November 3rd, many of you would recall the euro was just going up non-stop. So I asked the question, is the euro actually forming a bubble here? The second characteristic we discussed was once they get going, financial bubbles are marked by huge increases in trading, making them easier to identify. Volumes were getting huge in the euro against the US dollar. It was going up at the time of our last webinar for 19 straight consecutive trading sessions without any significant major price correction. Third characteristic was manias can persist even though many smart people suspect a bubble because not one of them has the firepower to successfully attack it. Only when skeptical investors act simultaneously, a moment impossible to predict, and then does the bubble pop. Another characteristic was investors dogmatically believe that they are right, and those who differ are wrong. And as one set of investors become less optimistic, another takes its place. Investors figure that they can always sell at a higher price. That view leads to even more trading, and at the extremes, prices can go beyond any individual investor's fundamental valuation. As the cliche says, the markets can remain irrational for longer than we can remain solvent, basically. Another characteristic we discussed was that at some point in a bubble, the optimist's enthusiasm runs its course. Prices turn down. There's an expectation that at this point investors who are skeptical may see prices as more reasonable and start buying. If they don't, that's a signal that prices have gotten way too high, and then they can tumble. So, I showed you also a chart 3 months ago of the great speculations that was put together. And here's the NASDAQ tech bubble burst between March 1995 through 2002, with the peak of March of 2000. You can see that right here. Then oil prices, very similar ascend. We'll see whether the move to the downside. And then Las Vegas home prices, the housing bubble here in the U.S. that actually burst. Note that shape over here. There's always a top and then a turnaround. So we looked at this chart of the euro against the US dollar, and that was that non-stop going up here for 19 days. And we noted that the euro was starting to establish somewhat, and this is, by the way, the long-term chart of the euro, pretty much a bullish euro trend since 2001. and a move from about 82 cents to above $1.60 for the euro against the US dollar. So we started asking now, is this decline that we're seeing of the euro in the last couple of years, is that the euro bubble basically bursting? That is going to be, I think, looking into 2011, is going to continue to be one of the main questions that a lot of investors, a lot of currency traders are going to be asking themselves. Especially now that we're witnessing in the recent couple of years that every time the euro makes a pullback, it goes through a little bit of a correction. Every time it goes back up again, it has not been able to continue higher than these previous highs established in 2008. As a matter of fact, every time the euro goes up for a few months here, and then for a few months here in the last recent several months in 2010 in the third and fourth quarter, excuse me, the euro has reached new highs that are lower than previous highs. The highs here were lower than the highs in 2008, the all-time highs for the euro above $1.60. Will, going into 2011, despite of any euro strengthening, will the euro continue to register lower highs, which is a definition of a downtrend. Lower lows and lower highs. Here's the previous low, which was broken recently with the euro dropping below $1.20. Previous lows were a little bit below $1.25. They were broken. Euro-dollar pair in 2010 went to as lows at below $1.20, below $1.19 even. On the way up, will the new highs also be lower than the previous highs? If that continues to be the case, then the euro is in a downtrend. The euro-dollar pair has produced a decent midterm correction, which we also asked, is that a reversal of the euro bearish trend in the first half of 2010? Or was that just a simple price correction of the euro's losses in the first half? And then after the correction is over with, what comes next? Does the trend, the euro negative trend, continue further? That's another big question that we're looking the answers for. We'll find the answers for in very soon, I think, in 2011, especially in the first and second quarter of the new year. We laid some of the Fibonacci retracement levels at my previous webinar, showing you that the euro is basically correcting. These are the losses for the euro in 2010, from a little bit above $1.51, about $1.51 and a half area, to the lows a little bit below $1.19. And we noted that 50%, 61.8% Fibonacci retracement were levels that were challenged during this price correction. And then the euro continued even higher a little bit in November, if you recall, to about almost $1.43. So it exceeded the 61.8% Fibonacci retracement of its losses in the first half of 2010. So here's that midterm correction for the euro against the US dollar that took place in the last several months. Here's the highs at about $1.51 and a half to the lows at below $1.19. The euro moved to exceed the 61.8% Fibonacci retracement and even almost approach the exact 76% Fibonacci retracement level, the next one above 61.8, with the highs at the $1.42, was it 81 or something like that in November. But then after that, investor concerns about the debt crisis, the problems in Ireland, the Irish bailout ultimately, continued to weigh on the euro, and the euro basically started coming off of these highs, and it looks to me like we might have a resumption of a previously established negative euro trend. Midterm euro trend might resume further, especially if the euro continues to decline and break below these recent lows that were reached in late November, a little bit below $1.20 at $1.30 rather, at $1.2969. That is the immediate most important price level that we are watching going forward in the short term, because a break below that level could mean the euro-dollar pair could then drop to these lows here that were reached in, was it August, late August, at the $1.2588, if you recall, just a little bit below $1.26. And now if these two support levels here are broken below, that would mean a continuation of the euro's bearish midterm trend versus the US dollar. So we basically had a huge decline for the euro in the first half of 2010, a price correction coming in the second half of 2010, and now into the first half of 2011, could we possibly have a continuation of the euro bearish trend versus the US dollar? I think that this is a possibility, and the answer to that question will be given to us if the euro continues lower and breaks below these important midterm support levels, which are again $29.69 and then $25.88. For the most part, however, we know that the long-term wise, the euro is in a positive, multi-year positive trend, which has been lasting pretty much since 2001. And all of this happening here in the pullback of the euro is simply a price correction. So I laid down some Fibonacci retracement levels for you to give you an idea of the moves of the euro-dollar pair from 2001, which, by the way, surprise, surprise, many of you who traded currencies at that time would remember the lows were right around a very important level in my quarters theory methodology. What was that? 0.8250 was the large quarter point there. The euro-dollar pair reached lows at around 0.8230, which was only 20 pips below the large quarter point at 0.8250, established support, and then started that multi-year positive trend versus the US dollar that took prices and the euro-dollar exchange rate from 0.8230, those lows at 0.8230, all the way as high to above $1.60, practically almost doubling the euro-dollar exchange rate. Since then, however, in light of the financial crisis, obviously the euro started coming under pressure. And I noted earlier, if you recall, that the euro started going through a period of a price correction. Most recently, the approximate 50% retracement level has been reached and even breached a little bit below, with the drop of the euro in 2010 below $1.20, below $1.19 as well. The next logical Fibonacci retracement level, if the market continues to push the euro to further price correction of its multi-year gains versus the US dollar, could not only be the 50% retracement area, which is approximately $1.21, and the previous support levels a little bit below $1.19, but should the market break below these levels, not only the 50% retracement in previous support levels could be challenged in 2011, but the euro's losses could continue to extend even further, and the market could continue that retracement to the 61.8% retracement level, which is currently estimated right around $1.12 for the euro-dollar exchange rate. Right ahead of that 61.8% retracement level would be the lows from 2006. Many of you would recall that the euro found support at around $16.5 area at that point in that year. So it looked like in 2010 that would be the area that the euro could challenge, but the euro-dollar pair did manage to find support once again this year into what a lot of major financial institutions estimate to be the, quote, fair value range for the euro-dollar exchange rate. And that fair value range for the euro-dollar exchange rate is estimated to be the 500 pip range between $1.15 and $1.20. So in the last 5 years, the euro-dollar pair has managed to find support during these price corrections. Because this was a price correction here of its previous gains. The euro reached the top a little bit above $1.30, what was it, $1.3750 or something like that, 38 or 39 maybe even, and then it produced a price correction. The range where the euro-dollar pair found support in 2006 was that fair value range again. It found support at the $1.16.5 area. And that was the fair value range between $1.15 and $1.20. When we take a look at the euro-dollar decline in 2010, once again, a large significant price correction, but the euro-dollar pair finds support below $1.19. Once again within the fair value range between $1.15 and $1.20. Needless to say, in 2011, should the euro-dollar pair revisit this 500th fair value range, it will be very important to see whether this time around the euro-dollar pair fails to find support within it. If it fails to find support within $1.15, $1.20 fair value range, then I think that the next logical price level that the market could take the euro-dollar exchange rate would be the 61.8% retracement area, which would be right around $1.12. We also noted that in the second half of 2010, the US dollar once again became the preferred currency for the so-called carry trades, especially against higher yielding commodity currencies, such as the Australian dollar, for example. We noted the resurgence of the US dollar carry trade in the third quarter of 2010 versus the higher yielding commodity currency, the Australian dollar. I explained at that time that this is not a coincidence. It is closely related, obviously, to the Fed's ultra-accommodative monetary policy. At the time, the Fed also started hinting that they're open to considering more quantitative easing. The so-called QE number 2 was announced on November 3rd, and we know what happened in the weeks and months before the Fed proceeded with that announcement. The Australian dollar started strengthening much earlier than that and found bottom at around a little bit above 0.80 cents area versus the US dollar in the summer of 2010. And to this day, it remains well bid. It actually touched parity once again in a trading session today, the Aussie dollar exchange rate. So we'll find out another interesting development to watch in the first quarter of 2011 would be if the US dollar carry trade versus currencies like the Australian dollar will continue forward. The Reserve Bank of Australia has been one of the few central banks in 2010 that has completely changed their accommodative monetary policy. Unlike the Federal Reserve or the Bank of Japan, the Reserve Bank of Australia began a campaign of interest rate hikes. And this campaign of interest rate hikes could continue in 2011. The only problem is that the Australian dollar is now back at parity with the US dollar. And according to some experts, it might be a little bit overvalued. And now that we're seeing China actually stepping on the brakes a little bit and cooling things off with the Chinese economy, which ultimately could have a negative impact on the Australian economy because it could reduce the demand from China, the largest trading partner of Australia. If that demand from China for raw material exports from Australia is being reduced, then that could have a negative impact on the Australian economy. So it will be very interesting to see in the first couple of quarters of 2011 if the Australian economy is going to continue to do as well as it has done in 2011, or will we start seeing the signs of weakness, the signs of a slowdown. Earlier today, we saw the Westpac Melbourne Institute leading index of economic activity for the month of October in Australia being released, rising that index to an annualized rate of 4.1%. So a lot of you would say, well, it's fine. It's up 4.1%. Yeah, but it was down from 4.5% in September. It's not a very significant decline, but this was the 6th consecutive month that this leading indicators index in Australia of economic conditions in Australia is showing us a 6th consecutive month of slowing economic growth. And because it is a leading indicator and we're looking ahead at 2011, if we continue to see signs of a slowdown in Australia, then the Australian dollar could suffer the consequences, especially if we continue to see more risk aversion, which is not going to be very helpful for the Australian dollar's trend. For the most part, however, the Australian dollar, of course, continues to be in a very strong positive trend versus the US dollar that has resumed since after the worst of the financial crisis was put behind us. You can see the Australian dollar dropping here. Many of you would recall on massive risk aversion. The Reserve Bank of Australia at that point came in, intervened several times to defend that 60 cents level for the exchange rate between the Aussie and the US dollar. And ever since then, the Australian dollar found the bottom, and we saw it reaching above parity. Actually, recently the Aussie reached as high as almost $1.02, $1.0182 were the recent highs. Right after the Fed's interest rate announcement on November 3rd, which gave us the quantitative easing number 2. With a lot of experts already forecasting QE number 3 in 2011, some experts are saying, well, the QE number 2 is not going to be very effective, and when the program expires in June of 2011, the Fed is going to consider another round of quantitative easing, number 3. If that continues to be the case, we know that would have a tremendously negative impact on the US dollar, as it would mean further debasement of the US currency, and that's definitely a factor that we're going to watch for going into the new year and into the first quarter of 2011. In order for the Australian dollar bullish trend to continue, we know what the definition is. It's not a rocket science. It's very simple. We have to see continuously established higher highs. Any failure of the Australian dollar to continue to do so, higher highs and higher lows, is the basis of a continuation of a positive Australian dollar trend. So now in this attempt for the Australian dollar to go back to the parity level, to test it again, is going to be very important for the bullish Australian dollar trend. In order for it to continue, we must see the Australian dollar break above these recently established highs in November at 1.0182. A failure to do so could mean a much more significant price correction for the Australian dollar's gains against the US dollar, especially the recent ones from the second half of 2011, which have taken the Aussie dollar exchange rate from above 80 cents to almost $1.02. Generally speaking, that is a move of about 2,200 pips, 22 cents. So that's a very interesting currency pair that we'll continue to monitor going forward. The bearish US dollar trend versus the Japanese yen came to a halt in the fourth quarter of 2010. Another big question going into the first quarter of 2011 is going to be, will the US dollar continue to gain some strength versus the Japanese yen? Well, we noted that the US dollar was very strong, the trend of the US dollar was a very strong bearish trend versus the Japanese yen, which prompted the Bank of Japan to step in and intervene on September 15th. Their first intervention, by the way, in foreign currency markets since 2004. The Bank of Japan decided that they can't take it any longer, and on September 15th, they stepped in and intervened at around 82.80 yen area. Those are the lows where my cursor is pointing at right now. We know what happened in the days after that. The US dollar bounced higher to reach some highs and double top resistance at 85.92 yen. 86 yen level was the level of resistance at that point. So dollar yen bounced higher, but it found the resistance a little bit below 86 yen. And then after that, we witnessed a slow but steady grind lower and lower and lower to brand new 15-year lows for the dollar against the Japanese yen, which were reached at 80.24, just 24 pips above the 80 yen level, very important level in my quarters theory, which I call the major whole number, major large quarter point at 80 yen. After the dollar found support in that area, though, we started seeing the dollar-yen currency pair going through a more significant price correction of its losses versus the Japanese yen, which were very significant losses, by the way, from around above 90 yen level to all the way almost to the 80 yen level. Pretty much a completion of the entire 1,000 pip range between 90 and 80 yen. During this price correction, the dollar-yen currency pair encountered some strong resistance around the 84.50 yen. 84.5 yen area remains to be, to this day, the problematic area for the dollar-yen currency pair. And going into the next couple of weeks and into the new year in the first quarter of 2011, that strong resistance at 84.50 yen will continue to be the level that we'll monitor very, very closely, because the only way the dollar could continue to strengthen against the Japanese yen would be dependent on whether or not there will be a strong bullish breakout produced for the dollar against the Japanese yen. If the dollar continues to fail, as it has failed in the last couple of weeks, this is, by the way, a daily chart of the dollar-yen currency pair. You can see the multiple attempts to break above that 84.5 yen area that were definitely unsuccessful. So there's a multiple failures here to break above that level, but that doesn't mean that that level will remain unbroken. The more attempts we make at a particular level of strong resistance, the higher the likelihood of that level to break. So we'll see whether the dollar will continue to do these attempts going forward, especially if what really has held the US dollar against the Japanese yen, as many of you will recall recently, is the increase in the 10-year Treasury yields, which is the benchmark preferred by the Federal Reserve here in the United States for the Treasuries and the yields, and that has been a helpful factor. And if that continues to be the case, if we get to see higher yields of U.S. Treasuries going forward into the first quarter of 2011, then that could potentially become the catalyst for the much-needed catalyst for the U.S. dollar to break above that strong resistance at 84.50 yen. Where to next? Well, of course, to the large quarter point at 85 yen, and just a little bit above it, below 86 yen, we have that resistance, the post-intervention highs from September 15, at 85.92. The door could be wide open for a revisit of these highs for the dollar against the yen if that strong resistance at 84.50 yen is actually broken. If it fails, however, to do so, the dollar could very easily resume its negative trend against the Japanese yen, especially if investors' sentiment sours going forward, and we get to see more risk aversion that could continue to hurt the US dollar but help the currencies like the Japanese yen and the Swiss franc for their relative safety. So what will be the factors that will drive the trends for the major currencies like the euro, the US dollar, and other currency majors in the first quarter of 2011? Some of them will be the same factors that we watched throughout 2010. The sovereign debt crisis in the Eurozone is far from over. The European Union summit last week produced nothing. 2 sentences is all we got from a 2-day meeting by the European Union officials. Does that show us some weakness and inability of the European Union officials to deal with their problems and make the tough decisions that must be made to stop the crisis from spreading? If the markets continue to price that in, if investors continue to remain unconvinced that the sovereign debt issues in the Eurozone are far from over, the euro could easily suffer the consequences of that. The worldwide economy is going to be very important. A lot of major economies are forecasting slower economic growth. Just this week, we had the Japanese government issuing a downward revisions of their forecast for the Japanese economic growth in 2011. Other major economies have done the same thing. The U.S. economic growth, however, on that quantitative easing number 2 by the Fed was actually revised higher. And as of today, we actually had an upward revision, even of the U.S. gross domestic product growth in the third quarter, 2.6%. U.S. economic growth in the third quarter of 2010 compared with 1.7% in the second quarter. And that is, by the way, an upward revision faster economic growth in the third quarter of 2010 compared, for example, with the economic growth in the United Kingdom, whose GDP numbers were also released earlier this morning, and they were actually revised lower than the previous couple of months' estimates. Is that beginning to show us some stark differences in economic activity of the worldwide economy, with the U.S. economy, which is the world's largest economy, doing better in the third and fourth quarter potentially of 2010, and other economies, especially the economies of countries whose governments have taken on fiscal austerity measures, beginning to experience the slowdown and the negative impact of these fiscal austerity measures in governments, in individual economies in the Eurozone and also in the United Kingdom. That's going to be a major factor that we'll watch in 2011 and in the first quarter of the new year. The monetary policy of major central banks, of course, is going to continue to be very important. I already spoke about the ultra-accommodative policy by the Federal Reserve or the Bank of Japan. On the other hand, we have other major central banks that are not as accommodative, such as the commodity-producing nations. Canada, Australia, New Zealand, their central banks have all started a campaign of interest rate hikes in 2011. Will these campaigns from them continue into in 2010, actually, they started the campaigns. Will these campaigns continue into 2011? That is also, of course, the monetary policies of major central banks are closely related to interest rates and yield differentials. And I already explained the importance there, which are also very closely related to the U.S. dollar carry trade. If the dollar continues to be the preferred currency for the carry trade, then obviously such higher yielding currencies could continue to strengthen. The U.S. and G7 corporate earnings will be important as we start a new quarter. That's always a very, very important factor that could gauge how U.S. and G7 corporations and large companies are doing and how the economy in general is doing. Throughout the last decade, foreign exchange reserve managers, as I mentioned earlier, have been really trying to diversify and look for better alternatives, other alternatives to the U.S. dollar. With the U.S. government spending, which is still very massive, and huge deficits that the U.S. government is running, will foreign exchange reserve managers continue to look for alternatives to the U.S. dollar? The euro was the best alternative in the previous decade, but now with the Eurozone debt crisis and the inability of European Union officials to address the problems and make the tough decisions, will other currencies in 2011 emerge as good stores of value? And could these better stores of value, we already be seeing some of the signs of that? What do you think about the recent strengthening of the Swiss franc? Do you think that this could be closely related to foreign exchange reserves managers and investors in general and currency traders looking for better stores of value than the U.S. dollar or the euro for that matter? So it shouldn't be surprising to see the strengthening of the Swiss franc, which, by the way, today has managed to reach brand new all-time lows against the euro. Brand new highs for the Swiss franc today, all-time highs versus the euro. To surprise, what's next? The large quarter point at 1.25 Swiss francs for 1 euro. Those of you familiar with my quarter theory methodologies would not be surprised to see that, because in the last 2 weeks I've been saying if the euro Swiss franc exchange rate actually breaks below that important support, which was the area of 1.2750 large quarter point. If you recall, in September the euro established a multi-year low, a new all-time low rather, versus the Swiss franc at 1.2765, which is only 15 pips above the large quarter point at 1.2750 Swiss francs. That level last week was tested with a new all-time low at 1.2757. And in the last 6 trading sessions since then, the euro has continued to weaken against the Swiss franc, continuously producing new all-time lows. When you take a look at if a trader were looking for some historical major support levels that could serve as a major next level that could be targeted, major level of support that could be targeted, they were basically non-existent. Because we're talking about uncharted territories here. No previous major support levels or multi-year or all-time lows for the euro against the Swissy. And that's why last week I said, when the euro, if the euro were to break decisively below 1.2750, then the euro becomes wide open versus the Swiss franc. And the losses could extend even further until the euro manages to find some support at some levels, whatever level the market decides. So this is where my quarters theory really provides a reliable roadmap to currency traders, especially when we have to deal with these uncharted territories, as an example recently with the euro against the Swiss franc. So what will be the next logical price level that the euro Swissy could have challenged and possibly found support at below the previous all-time lows around 1.2750 area? Well, the next large quarter point below is 1.25 cents. And surprise, surprise, this is where we're seeing the euro-Swiss franc exchange rate as we speak. Now, if that area is broken below decisively, that could open the door to the move into the next large quarter between 1.25 and 1.2250. This is basically just to answer one of the questions there, because I noticed in a previous presentation there were some questions. What about the euro against the Swissy? So that's my outlook on the euro against the Swissy. Could it continue lower? Sure it could, especially if these factors continue to weigh on the euro against the Swiss franc. And the Swiss National Bank was sitting on the sidelines. Last Thursday they had an opportunity, they had an interest rate announcement last Thursday, and unlike in the first half of 2010 when the Swiss National Bank even intervened, not only used very strong language to curb the strength of their currency and to express concern about the rapid appreciation of the Swiss franc against the euro and other majors like the dollar, unlike they did in the beginning of 2000 and the first half of 2010, this time around, last Thursday, the Swiss National Bank basically did absolutely nothing, not even a single word addressing the weakness of the euro and the rapid appreciation of the Swiss franc. Basically, traders at that point felt that the door was wide open to continue to push the euro lower. And as long as that door remains wide open, the euro could continue to decline against the Swiss until either the Swiss National Bank steps in or we start hearing some more positive news from the Eurozone that the debt crisis there is going to be stopped from spreading. For the time being, the European Union summit also didn't produce a whole lot. And we continue to see the credit ratings agencies like Moody's, Standard & Poor's, Fitch Ratings continuing to come with some warnings and concerns about in credit ratings downgrades. And that's another factor that we'll continue to watch into the first quarter of 2011. When it comes to the Eurozone debt crisis, the first quarter of 2011, the first and second quarter of 2011 are going to be very important ones to see whether there will be another phase of the European debt crisis. Because Spain, which is one of the largest economies there in the Eurozone. I mean, we know Greece and Ireland had problems, but their economies are not as large as the Spanish economy. And I'm sorry to say that for our friends from FX Street who are from Barcelona, Spain, but that is the reality. A lot of Spanish debt obligations are coming due at the end of the first quarter and the beginning of the second quarter of 2011. Along with that, Portugal debt obligations are going to be due. I believe that these Moody's last week estimated that Spain credit rating may be cut from their current credit rating, citing vulnerability to funding stress of these debt obligations that Spain and other European Union members will be facing in 2011. Moody's estimated that Spain has to raise 170 billion euros next year. Will they be able to raise these funds on the open markets in a market where investors remain unconvinced that the crisis is far from over and they continue to demand higher yields and higher premiums in order to hold the debt of nations like Greece, Ireland, Portugal, Spain, and even Italy, and even France, which French government debt has now seen some of its highest premiums in recent years, if not ever. Moody's estimates that Spain has to raise 107 billion euros next year, while also refinancing the needs for its regions, totaling 30 billion euros, and Spanish banks must raise around 90 billion euros. Although Moody's said that the bailout for Spain isn't likely, we heard the same thing with Greece and Ireland. That bailout there was not likely, that there's not going to be a bailout, that Greece and Ireland are going to be able to finance their own debt obligations on the open markets. But we know what history has shown us. Will we see the next phase of the Eurozone debt crisis in 2011? I feel that there is a significant possibility for us to witness that. And we'll watch that end of the first quarter, beginning of the second quarter of 2011, when Spain, Portugal, and other European Union members meet their debt obligation deadlines. So this is all I have for our program today. Thank you very much for joining me today. If you'd like to listen to my daily outlook on the currency majors, make sure to tune in to my daily live program called the All Things Forex broadcast, Monday through Friday, 1 to 2 p.m. Eastern Time. I'd like to thank our friends from FX Street for putting this event together, and I'd like to wish all of you a Merry Christmas, Happy Holidays, and a Happy New Year, and I'm looking forward to seeing you again in 2011.